Welcome, everyone. We're really pleased to have you with us for our 2025 economic forecast. My name is Roger Ballard, CEO for Nuvision Credit Union. I'm thrilled to welcome you to this particular webinar. We started this economic forecast series with my good friend, Dr. Chris Thornberg from Beacon Economics back in 2023. And we really did this and continue to do it because we were trying to make sure that we provide our members with some great information and tools and insights that really will help you make decisions in your lives. Just a little bit about Nuvision. Some of our members might be brand new to Nuvision, or some of you may have been members for many decades. And so, our purpose at Nuvision is we help build lives for people, talking about our members who are also our owners, the communities in which we operate in, and for our team members. And our vision that we focus on each and every day with the help of over 600 of team members is Nuvision's passion and commitment to enhance members' lives. We'll achieve best-in-class member experiences. That's what we strive for and try to work to getting better each and every day. I'm really proud to work with a talented team here at Nuvision, serving over 200,000 members. We are very proud to run a safe, strong, and secure credit union for the benefit of our members. And we're a cooperative. That means we're owned by our members. And that's why we really, too, focus on how do we provide some great information that helps you make decisions in your life. So that's what one of the things we're here to do tonight is to provide you some information. Dr. Chris Thornberg, he's with Beacon Economics. He's a leading industry expert. He's going to talk about a number of items regarding the economy. It's been an interesting 2025. Most people can agree on that. There's been a lot going on. So we're going to talk about the state of economy, some challenges and risks we see in the economy, some key indicators to watch for. Again, Chris, Dr. Thornberg really does a great job of summarizing and focusing on what really matters, because you look in so much of the news and mainstream media and such, you hear so many different messages, it's hard to make heads or tails of that. And so he does a great job of really focusing and giving his perspective about what we really should be paying attention to and what his outlook is in 2025 particularly. So we're really just excited to have Chris back with us again. And again, we really encourage you to ask your questions. Now, I'm going to let Chris, kind of take the mic here in a moment, and he's going to do his presentation. Then I'll come back and Chris and I will take the Q&A. But along the way, if you have questions, just submit those and we'll do our best to save time at the end. So use that Q&A icon, type in your question, and I will try to get to it. Especially if I see kind of similar themes of topics, I'll try to really make sure we get to those questions. We'll do our best to get to as many of them as we can. Again, I'm so honored, and it's a great treat to have the expertise of Dr. Chris Thornberg. Chris, good evening, good afternoon. I think
Good
it's
evening
early
and good
evening for
afternoon.
us. We're so glad you're here.
Absolutely. And it's good to see you again, Roger. Now, we started back in 2023. We did have a little bit of a pause last year, if I remember correctly, but maybe a few month pause, but we're back at it. I'm excited to be here and to talk about what's happening in our world. For those of you who might need a little bit of a refresher on this particular topic about Beacon Economics, I started this company almost 20 years ago now. I was a faculty member at UCLA working in the UCLA forecast, and decided that a lot of what I did there I could do more effectively in the real world. And what that is more or less helping people understand what's going on in the world. And very specifically, we're nonpartisan. We are committed to letting the data drive the answer. That is a founding principle we've had since the day I started this firm. And the interesting thing is that I didn't really appreciate how much harder that job was going to be as time's gone on. And it's caused me to think a lot about what I do as an economist and a forecaster. And as a result of that, you will see today, and the conversation we have today, kind of broken up in a very specific way. One of the things we're going to talk about quite a bit today is what we think's happening in the economy, what you might want to call our social narrative or our lived experience. I'm also going to talk about what's actually happening in our economy. That is the objective statistical reality that I see in the data on a day-to-day basis. Now, I would tell you that when I did my PhD, I was taught that these were very much the same things. And we have a term for it in economics called the rational agent model. But of course, since that point in time, getting in the real world, I've realized that the world doesn't work quite this way. And by the way, understanding this, appreciating the difference between narratives and reality is what you need to do in order to be a good forecaster. Because ultimately, it's narratives that drive decisions, the decisions of households, the decisions of business leaders, the decisions of politicians and policymakers. They make decisions based on narratives. But in the end, the outcome of those narratives, well, it's based on economic reality. So if narratives are based on the right, I'm sorry, if the choices are based on the right narrative, we're likely to have the right outcome. But if they're not, well, that's the problem. Ultimately, good choices and smart policy start with the correct narrative. And more, what I see in our world is the false narrative, the wrong narrative. And that's driving, I think, some important imbalances in our economy. Now, with that being said, you want to talk about narratives. The last few years have been very interesting when it comes to narratives about the U.S. economy. Um, I don't need to go too far back in time, but I would like to remind everybody that it was back in 2019 we had one of the many recession calls we've been hearing. And in 2020 we did have a recession, but we were told the pandemic was going to cause a depression, 10 years, of course, of decline and debt, as the case may be. In 2021, we were told the economy wasn't never going to recover when, by the way, it was already roaring back. In 2022 was the inflation catastrophe. In 2023, it was the yield curve recession. A lot of negativity in the forecasts, all wrong, as the case may be. And if you've been in for the last couple talks, you'll recognize that. And of course, in 2024, well, the narrative shifted last year. In fact, last year, we suddenly became envy of the world, at least according to some corners. And that started worrying me. There's an old expression, the best way to use economic forecasts is to bet against them. But of course, back in 2025, we're back on the negative side of things, and now we're hearing about trade war recessions. All this chaos, of course, in the forecast reminds me that the only function of economic forecasting is to make astrology look respectable. At the same time, we also, of course, saw another narrative last year having to do with politics and, of course, the election we had last November. And we were told right up to Election Day that this thing was absolutely a toss-up. No one could predict what's happening. And in the end, it wasn't even close. It was a complete washout. And that's true even here in California, left-leaning California, where we voted a number of propositions down that I never thought I would see the day. For example, a minimum wage proposition. And by the way, this reminds me of another saying, which is the only function of election polling is to make economic forecasting look respectable. Now, we have not bought into a lot of these negative conversations over the last few years. We contribute to the Wall Street Journal survey of forecasters. One of the questions they ask us is, what is your probability of a recession in the next year? You can see our numbers right there along the bottom. We were basically some of the most optimistic guys out there. And we continue to be optimistic. We don't see a recession in the next 12 months, as the case may be. Now, mind you, it isn't to say that the economy is 100% fine. Clearly, the economy is downshifted from where we were a couple of years ago. But that said, what was going on a couple of years ago was that the economy was wildly overheated by the excessive amount of stimulus thrown at the economy by the Federal Reserve and Congress back in the day of the pandemic. But with that said, yes, the economy's cooled down, but so is inflation. And some of the stresses on the lending system has also cleaned up, and it's becoming easier to get loans. And even with the cooling off, overall household finances still remain really solid. In other words, at the top level, this economy is just fine and will continue to grow. Now, with that said, I have some worries. Always, right? I'm an economist. What economist doesn't have worries? But for me, the worries aren't necessarily directly about this administration and a lot of the things we've seen, but rather it's about why household finances look so good. Look, right now, real incomes are rising. Right now, wealth levels are at all-time high levels. But the reasons for this are the fact that A, we're not paying for much in the way of our federal government spending. Our federal government is running enormous deficits. Of course, Americans benefit from that in as much as we get all the wonderful benefits, the Medicare and the Social Security, and of course, the national defense. But the downside is, of course, that we're not paying for it. Someone else is, and that, of course, is the people buying treasuries. Well, that means our incomes are not as high as we think they are because more or less the government is borrowing on our behalf. The other reason goes back again to that asset bubble I was just referring to. Asset prices right now look, well, definitely frothy at the nicely. They look frothy. And at the other side of it, it's a flat out bubble. And of course, that makes us feel wealthy. But remember that that's based on a false interpretation of asset prices. So you add it up, sure, households look financially great, but it's based, of course, on very weak foundations. And by the way, those foundations are not new. They've been in place for years. It's not, of course, just Trump, it's Biden as well. Now, with this new administration, what does that mean? We big change of policies. We know, of course, that Trump has come in, a lot of executive actions, policy uncertainty is going through the roof right now. But all that being said, you got to take a step back. There's a lot more smoke than fire here, and all these things that are happening. Right off the bat, executive orders don't have nearly the power that you might think. A lot of these executive actions have already been uh, told, but has already been voted down by the courts, so to speak. They said this isn't legal. This isn't how the government works. The executive branch can can basically manages the economy, but they don't set laws. They don't set policies. That's the purview of Congress. That's, of course, exactly why all of these executive actions don't do anything substantial or permanent for our economy, because whatever they put into place now can just be reversed the next time a new president comes into power. For me, the worry is less about what this administration is going to do and way more about what they're not going to do. Because what they're not going to do is deal with the bubble. What they're not going to do is deal with the deficit in any substantial way. And therein lies the problem. And again, it's not a problem with Trump. You could say exactly the same things about the Biden administration. Our government is ignoring the obvious, which is our economy is overheating, our economy is overconsuming, and it's not sustainable. Now, with all that said, there's a big difference between Trump and Biden, and that is this: that Biden was more or less maintaining the status quo, where Trump wants to break the status quo. Now, in both cases, their motives are not about dealing with asset bubbles, they're not about dealing with deficits. It's more about the politics of our land as it is today. And I will tell you is that Trump may indeed set off a crisis. He could set off a recession if he continues to shake the boxes hard. But it isn't so much because of what he specifically is doing, but rather because of the chain reaction he could set off if foreign investors suddenly don't want to invest in the US economy. Now, there's a lot to get there between what I just said and the end of this slide deck. What I want to do is I want to jump in on this. I should remind you, as I'm wrapping up my last couple slides, there will be a QR code. If you want to get a copy of this deck, you could take a picture of that QR code. You don't have to worry about saving it. If you missed the QR code, don't worry about it. Nuvision Credit Union, Roger will get a copy of it. He will share it with everybody as well. So with that said, a lot to talk about. Let's jump right in. The economy coming into 2025 has been doing great. GDP growth has been running near 3% the last couple of years. This is a very solid number for an economy that's labor force constrained. One of the big driving factors of growth has been consumer spending. And consumers, by the way, aren't just spending, they're having fun. Foreign travel is at a record high level, significantly above where it was, 60% above where it was prior to the pandemic. Restaurant sales, 50% higher than they were prior to the pandemic. Las Vegas has never been busier. Now, things have moved around. Look, people respond to relative prices. And as a result of that, well, some things are slowing down. For example, consumers have realized that restaurants are getting pretty expensive, and restaurant spending and hotels in general cooled off over the course of the last year. With that said, other parts of the economy have simply picked up, including, for example, spending on motor vehicles or spending on furnishings. Now, the number on motor vehicles might be a little surprise for those of you tracking the auto market, because you'd be like, wait, unit sales really haven't come back all that much. And that is true. If you look at overall auto sales, they're running a little less than 1.3 million per month, which is pretty far below where we were prior to the pandemic when it was running above 1.4 million. But with that said, don't confuse quality and quantity. What's really going on here in the data is that maybe we're selling fewer cars to Americans, but the cars they're buying are significantly nicer. On the right-hand side, I have the inflation adjusted, or the real value for each vehicle sold. Back in 2018, the real value of a vehicle was roughly 65,000. Today it's 80,000. In other words, people are buying fewer cars, but they're buying much nicer cars. And that's true for wine as well. If you're here in California and you're paying attention to the wine biz, every time you turn around, you'll hear another scary story about the collapse of the wine business. But when you dive right in, suddenly it doesn't make just that much sense. Absolutely, there's been a decline in the gallons, the actual physical quantity of wine being purchased. But with that said, take a look at those middle numbers. That's real spending on wine. And yeah, that number's going up. How do we square fewer gallons, more real consumption? Well, that's a function of quality rather than quantity. On the right hand side, the big decline in grapevines in California is in Fresno. And of course, well, that's a different kind of wine than what you see in Napa. There's a big market for the $100 bottle, but the $10 bottle, that's being replaced by White Claw. It's a different kind of conversation. Look, overall top line household distress remains very, very low right now. On the left here is foreclosures and bankruptcies coming into the end of 2024. Those, again, are half of what they were in 2019 as a percent of the population. In 2019, they were record low levels. Overall household debt, look at the debt servicing ratios. They're not that high right now for either mortgage debt or other types of debt. Americans really aren't carrying overall a lot of debt. Now, I get it. There has been an increase in delinquency rates on auto loans and credit card loans. Again, it's not a function of what I would say is an overall problem in the economy or household finances. Indeed, on the right-hand side, this is the total share of auto and credit card debt in our economy as a share of disposable personal income. And yeah, it's really low right now. It's low from any long-run standpoint. So what to take away from this? Well, look, a couple of years ago, the economy was violently overheated. Everybody was partying. Things have slowed down. And yeah, suddenly some people have found that getting in the head of themselves. This is more about a personal decision, about being careful about where the economy is going, appreciating that it can slow down, and being prepared accordingly, rather than some sort of big systemic problem that desperately needs some sort of government interaction. Those are different interpretations of that data. And candidly, mine is, I think, makes a lot more sense. Labor markets, again, same sort of picture. Unemployment rates still remain around 4%. It's cooled off a bit, but still good numbers. Job openings rate down, but from where it was in the crazy days of 2021, but still basically where it was in 2019. No increase in layoffs. Real wages continue to rise. Over the course of the last year or so, inflation adjusted hourly wages have risen about 2.5%. And by the way, that's the same for the top and bottom of the distribution. This isn't all being driven by the top 10%. You hear that all the time, but the data actually tells a far more nuanced picture, as the case may be. In fact, over the last decade, the bottom half of workers have seen about a 17% inflation adjusted increase in earnings compared to 10% for the top half. So income inequality has definitely come down a bit. And by the way, if you're a little dubious on those labor costs, just ask anybody who runs a restaurant or a retail station or a gas station or a hotel, and they'll tell you that they see the big increase in earnings because their labor costs are going through the roof. This is all a function of that tight labor market. And even when it comes to, say, metrics such as the poverty rate, well, that's near an all-time low level. And yes, across different income levels, we're seeing increases in net worth. This tide has truly raised all boats. Even when it comes to kind of regional growth, what you can see here, of course, is that the pattern of growth across different parts of the U.S. aren't the same. The biggest growth states are Idaho and Texas and South Carolina. We probably know about that. But with that said, those areas may be growing faster. That doesn't suggest a big slowdown in other parts of the United States. In fact, growth is up. It's just at a different pace in different parts of the United States right now. And if you take a little bit closer look at unemployment rates and average weekly earnings, in a lot of these markets, the markets are still very, very tight. Overall incomes continue to rise as well. And of course, here on the Pacific Coast, we have some of the highest incomes in the United States right now. So perhaps the West Coast isn't quite growing quite as fast on the extensive margin, but we are growing on the intensive margin. And even here inside California, you could see a really interesting breakdown of the data. It is actually true that Hispanic and African American households have seen more income growth than the average over the course of the last 4 years. That's a nice change. You're seeing inequality falling. And some of the most rapidly growing increases in household income in the state of California are actually in some of our inland regions, including Stockton and Fresno and Long Beach and Sacramento, places you might not expect. So yeah, there are a lot of good things happening in a lot of good places. The big difference in growth prices across different places, of course, is simply a function of labor supply. For example, here in California over the last 5 years, from January 20, January 25th, the state has added about 400,000 payroll jobs. Not a big number, but that being said, the labor force has only expanded by about 100,000 people. I mean, that's kind of a neat trick when you think about it. And when you want to compare California to Texas, well, for me, the entire story boils down to one thing, and that's housing permits. Texas builds housing, California doesn't. Arizona does. And the net result of it, of course, is while Texas and Arizona's labor force is growing very rapidly, here in California, it's barely growing at all. That's the biggest issue of all. It's really a conversation about state population. And boy, if California's population growth is weak, Alaska's is even weaker. These are places that really need more people. That's the biggest problem they face, rather than some sort of economic decline. Even housing. The housing market has obviously seen a big decline in sales. Interest rates are a big part of that. But look around, you look at the inventories, month supply, there's very little to buy. And it's that shortage that is driving prices up. Home prices continue to rise. The price of a single family home in the United States, median prices went over 450,000, a record high level at this particular point in time. And of course, taking a look out here on the West Coast, well, you can see some of these numbers, right? Washington is approaching 700,000. Oregon's at 500,000. California is approaching 900,000. Alaska is at 400,000. The issue here is a lack of sellers, not a lack of buyers. That lack of sellers, of course, is what's causing the market to go up, even though housing is relatively unaffordable given interest rates. Well, how's the credit environment looking? Well, even there, things have been looking pretty good. Look, over the last couple of years, with all the shifts in Fed policy and all the increase in interest rates, commercial and credit union delinquencies have remained very, very low. Our lending systems in the United States look rock solid. They continue to be very, very clean in this economy. One of the big issues in the lending system over the course of the last couple of years was a lack of available money. You know, last 2 years, so the Federal Reserve engaging in quantitative tightening, which is the opposite of quantitative easing, sort of taking money out of the economy. And that, by the way, shrinks the money supply and also reduces the deposit base. For the last 2 years, the deposit base in the banking system has been shrinking. That has really prevented credit from getting into our economy. Well, that reversed in 2024. You actually saw the Fed back off a bit. Suddenly deposits are growing and lending is activating. And even here, you're starting to see it easier to get a loan. We have something in the US called the Senior Loan Officer Survey, where they ask a bunch of lending officers, well, are you making it harder or easier to get debt? Are you seeing an increase in demand or a decrease in demand? And what the lending officers are saying right now is we're not tightening, we're actually loosening just a little bit. And yeah, there's actually been a little bit of an increase in demand for mortgage debt finally, suggesting that really, again, coming into 2025, the economy has a tremendous amount of momentum. And then you add to it the fact that inflation, will not beaten, is way down. The NASDAQ has taken off. The Federal Reserve did cut last year a few times and slowed down the pace of quantitative tightening. Even our Bitcoin portfolios have leapt up, not quite as that high as that, low $100,000 range it was at, but still way above where it has been before any point in time here. Still not a believer in cryptocurrency. If you're wondering why, wonderful book, a biography I read of an Italian American gentleman. I suggest you pick it up. Now, with all that being said, what is the national attitude out there? And the answer is it's grim. And it's not just grim over the last few weeks with all this policy uncertainty. Consumer sentiment today, coming into 2025, is well below where it was in 2019. So is Gallup's U.S. satisfaction rating saying a very similar thing. We continue to hear headlines that about Americans living paycheck to paycheck, and 7 out of 10 kids saying the country is headed in the wrong direction. And again, at the end of 2024, I showed you all the data, but nevertheless, 70% of consumers still feel like inflation is outpacing incomes. So everything is great, but our mood is pretty grim. And this brings me, of course, to that first concept I had, is that there are narratives and the realities, and they don't necessarily overlap. Now, they usually do. Narratives typically reflect reality. That's where these Venn diagrams come together. But a lot of times, such as, for example, the positive value of Bitcoin or the unsustainable federal deficit, well, you suddenly don't see you don't see the interaction here, right? The positive value of Bitcoin, the unsustainable federal debt, these are examples when narratives and reality don't align. Take, for example, the positive value of Bitcoin. My frustration with cryptocurrency markets is very simple. Any kid with a master's degree in computer science can make another cryptocurrency. There can be a literal infinite number of cryptocurrencies. How can any cryptocurrency be worth something if you can have so many of them? There's no answer to that. But that said, there's a lot of people who do believe in this, including, of course, our president and Elon Musk, and they have the rationale, and that rationale has caught on in the public narrative, and people think there's value there, and they're investing in it. The power of the narrative. On the other side of it, of course, I think of our federal deficit, and we'll be ending our conversation there today to talk about that. But it's scary. 6% deficit, 6% of GDP deficit right now, 100% debt to GDP, enormous obligations for Social Security and Medicare. This should be an absolute crisis, and yet it barely played a role in last year's presidential election. It just wasn't discussed. In both of these cases, you see the misalignment, and I can tell you that more often than not, economic reality will inevitably reign on social narratives that are wrong. And when it does, what happens? What happens when we realize that the deficit is truly a crisis? What happens when we realize that, of course, Bitcoin shouldn't have any value? These are big questions. And of course, what happens when that happens? Well, guess what? It depends on the narrative more than anything else. Now, this has been discussed. Robert Shiller brought this up in narrative economics a couple of years ago. You have to pay attention to narratives, otherwise you miss a potential mechanism for real economic change. But Keynes talked about it when he said markets are moved by animal spirits and not by reason. He's talking about narratives. And of course, Will Rogers famously said, it isn't what we don't know that gives us trouble. It's what we know that ain't so. The fact that human beings chase false narratives is nothing new. This is who human beings are. This is what we're about. And you can see the power of the narrative, particularly over the last few years. Go back to, for example, to the pandemic. I was very vocal on this, that the pandemic, while a tragic human circumstance, was never going to cause a depression. That's obvious. You can look at the history of business cycles. We've never had a depression caused by a pandemic. 100 years ago, we had the Spanish flu, which was way worse than COVID, didn't cause a depression. Why did this become the narrative? I couldn't tell you. But it caught a nerve and it took off. And the next thing you know, you had Washington, D.C. responding to a depression crisis that was never a depression crisis. And how unbalanced was that? Well, look, we lost about $1.2 trillion in output as a result of the pandemic, but the government used $6 trillion of stimulus to deal with it. That caused a $50,000 increase in household net worth all by itself. But of course, that set off a massive asset bubble, which turned around and gave another $200,000 in net worth. So that enormous stimulus set off this chain reaction, which caused the U.S. economy to just take off like crazy. Now, the other thing it did was, of course, was also cause inflation. Well, it had to, because that $6 trillion in stimulus was funded by $5 trillion in brand new money through the form of quantitative easing, which caused a 40% increase in the money supply. An increase in money supply combined with enormous increase in demand, that leads to inflation. The truest cliche in economics is that inflation is caused by too much money chasing after too few goods. Of course, the Federal Reserve overdid it, caused inflation. But that being said, we have to keep in mind that it was a demand-driven phenomenon. All the time you hear over and over again, households are being crushed by inflation. Well, no, it doesn't work like that. If households were being crushed by inflation, demand would slow. And if demand slowed, prices would stop rising. So when you see inflation, it's really driven by that excess demand more than anything else. Now, things have calmed down. I keep saying this over and over again. We've cooled off. The Fed is backtracked. They're now tightening as opposed to stimulating. And the bounces, of course, have been pretty intense. We had the implosion, then the vaccine bounce, then the inflation policy reset. And now we just got back to normal. And by getting back to normal, that means durables are settling down and services are picking up, and we're being a little more responsive to relative prices. But the outlook for consumers is still very good. Real disposable incomes continue to rise. Average net worth has taken off again over the last year and a half with the reemergence of the asset bubble. We're now up $360,000, 38% higher. This is still really good numbers. But everybody's miserable. Why? How? Well, look, there's just too much to talk about here. But you got to look into the Daniel Kahneman's book, Thinking Fast and Slow, where he gets into the idea that there's two ways we think. Whereas the type 2 system, which is fast and incredibly smart, I'm sorry, it's not fast, it's slow, but it's incredibly smart and able to figure out really complicated things. But at the same time, the problem with our type 2 system is it's slow, can only do one thing at a time. And by the way, it gets tired pretty quick. We all know what being burned out at the end of the day feels like. Well, who's driving the show the rest of the time? Well, it's type 1 thinking. And type 1 thinking, that's the fast system. That's the emotional, it's quick, it's more enormously effective. But with that said, your type 1 system is not built in the same way. It's not built to be skeptical. It doesn't look for the truth. It just grabs information and runs with it. That system, of course, is highly prone to misreading what's going on. But then you also got to throw in a little bit of Jonathan Haidt. He's a wonderful sociologist, wrote a book called The Righteous Mind. And in this one, he talks about when it comes to certain issues, it isn't just that we might default to our type 1 thinking, but with certain social issues, the way our brain is structured, well, that causes our type 1 thinking to take off. In other words, when it comes to things like loyalty, or authority, liberty, or care, in these sort of circumstances, your emotional thinking takes over and pushes your rational thinking to one side. Well, as you can see, this is a good way for a lot of people to get really riled up about things, even though maybe they don't exactly exist in the way we think they do. We don't think as much as we think we think. And this all leads me to my favorite graph that I found last year from the Federal Reserve. This is a survey where they did of a whole bunch of Americans, and they asked, how are you doing on a scale of 1 to 100? Now, in 2017, that average person said, a 74. In 2023, they said a 72. Now, in 2023, they're better, but I'm not going to worry about it. For me, that means people feel the same now as they did a few years ago, and that said the world is fine. But they also ask these people, how's your local economy doing? And how's your national economy doing? And notice that those numbers are lower and getting worse. So in other words, your average person thinks they're doing fine, but the average person thinks the average person is doing badly. Well, this, of course, explains everything going on. We're all fine, but we're sure a whole bunch of people are doing terrible. And that's why everybody's running around with their hair on fire, despite the fact that in any aggregate sense, Americans have never been better off than they are right now. But that begs the question, what happened in this last election? If everybody's so happy, why the big change? Well, go back to the narrative, right? People were really upset about inflation that caused a decline in consumer confidence. And when I look, let me explain what this is. This is basically looking at the change in the University of Michigan Consumer Sentiment Index from the beginning of a term to the end of a term, and then asking if that incumbent party maintained control of the White House or lost. And every time consumer confidence falls, we have a change in president. That happened to Trump, by the way, in 2020, and it happened with Biden in 2024. In 2020, it was the pandemic. In 2024, it was, of course, inflation. In 2020, I can tell you, Trump didn't cause the pandemic, but he got tossed on anyway. Biden didn't cause inflation, but he got tossed on anyway. This is the way politics work. Now, you might think that this means, it's the economy, stupid. But remember, in 2020, we had the pandemic, consumer confidence was down, and the economy was pretty bad. In 2024, consumer confidence was down, inflation was up, people were doing great. But the narrative said something else, and it's the narrative that actually counts. So here we are. We have our new administration, and it has been a wild few weeks, a lot of things going on. We know about the DOGE efforts to cut spending. We know about the tariff conversation, the federal funding spending, and of course, all the ICE raids that are going on. The policy uncertainty indexes have been shooting up. The S&P has dropped off some. It's stabilized. And keep in mind, it's still higher than it was 5 months ago. So it's hardly the end of the world for the stock market right now. And yeah, we got this crazy negative number from the GDP now. All this has to do with the surge of gold imports in the start of the year, as it turns out. With all that said, look, the real problem we have in our economy in the long run perspective is the fact that we don't have enough people. So let's talk a little bit about that and think about where this administration sits. Birth rates have been down a lot over the course of the last couple decades. In fact, there was a brief period of time in the 90s where we almost had enough birth rates to maintain population growth, but that's dropped substantially since the Great Recession. That result of that is we have very weak labor force growth, few years ago, a bunch of economists pointed out that immigration reform would allow for more labor force growth, which would allow for more GDP growth, which would be, by the way, a great way of dealing with our federal deficit. And we have been getting those immigrants. Now, not all of them, of course, are actually legal through our legal system, but they have been coming. To give you a sense of it, just how important this is, take a look at that F10 side. We just got some new data on this. And really, over the last, 14, 15 years or so, really about 2010, this nation has added about 16 million workers. And believe it or not, half of those workers were born overseas. So half of our new labor force supply has come from the rest of the world. Well, that's a big change. Not for California, not for New Jersey, New York, or Florida. This is business as usual. And by the way, this new surge of workers is certainly helping the economy roaring, but it also was named one of the biggest problems for the US economy in the run-up to this last election. Well, why? Again, numbers look pretty good. Well, we have to keep something in mind. One of the big issues here is where immigrants are going now. On the left-hand side here, this is the change in foreign-born workers compared to the share in 2013. And it's really areas that haven't had a lot of immigration in the past that are seeing the biggest increases. And this may be causing some of the, shall we say, frustrations in our economy today. But that said, what does it mean for the economy right now? We're dependent on these people. Are they going to be getting tossed out? Well, the answer is no, they're not. To be clear, there's still rule of law in the United States, and you have to go through a process. And that's the issue, the process. We don't have the manpower to collect people. We don't have the detention facilities to hold these people, and we don't have the courts to try these people to figure out what's going on. It would take us a decade, given our current capacity, to even get through part of all the files that are currently in place. And of course, it doesn't help when the administration's at loggerheads with a lot of states like California over this particular issue. This is why you saw a decline in deportations under Trump's first administration from Obama. It's because he talked about it so much, and a lot of the states hardened up and slowed things down. Now, of course, they really slowed down under the Biden administration when you think about, of course, what was going on in the context of COVID. But that said, I don't think you have to worry too much about a whole surge of deportations. But with that said, what you can worry about is the fact that labor supply will slow down again. Remember, it's during the last Trump administration that people coming into the nation really cooled off. And that means, remember, half of all new workers were born overseas, more constraints on labor force, and a tighter labor market. And one of the things that the United States have had to do is to rely on our neighbors here in North America more because our labor force growth has been so subdued. Here in California, our labor force in the United States, excuse me, our labor force has grown about 7.5% over the course of the last decade. In Canada, Mexico, it's been 17.5%. Why so much higher? Well, Mexico, it's birth rate, and in Canada, it's immigration. As a result of that, when, for example, in the last Trump administration, when they had tariffs put on China, we didn't see onshoring, we saw nearshoring. They went to Mexico, they went to Canada, and of course, Mexico and Canada, by far and away, are our biggest trading partners. Now, another big story, not just getting rid of workers, but of course, putting the tariffs on Canada and Mexico, and that's ongoing. And it's not just Canada and Mexico, it's also EU, and we're talking about steel and aluminum. And it asks the questions, how does this ripple its way through our economy? Now, it isn't as big of a deal. I mean, look, even if you really slapped a lot of tariffs on different parts of the economy, you're primarily going to see it in a few industries. Autos, for sure, if we do it there. Anything having to do with metals, that's definitely going to take a big hit. Some things having to do with airplanes. But for the most part, it's would only lead probably to, a 0.5% or a percentage point increase in inflation rates. It's not going to be that big of a number, as the case may be. For me, it's really more about how it makes other parts of our economy that much more expensive. For example, housing, which is a story I'm going to come back to, and cars in particular. Look, cars and housing are subject to these tariffs. Cars, because we have an integrated supply chain across our borders with Mexico and Canada, and this could really mess with that. And houses, because they use a lot of those metal and wood inputs, and not to mention labor. So these kind of extensive external relations could have a big impact on cars and houses, and well, that's typically what people want. One story I heard is that a new home could go up by as much as 22,000. Well, I think that's a little extreme, but it does give you a sense of things. And even more importantly, remember, it isn't just what we do to our neighbors and how that spills into our economy. It's probably more about what they do in response to us. I mean, Canada is doing export taxes on oil. The EU is retaliating against American whiskey. This could create a substantial amount of turbulence in the US economy. Could it cause a recession? I don't think so, not by itself. It's not big enough. But it could definitely create some disruption. And yeah, it could change prices in your local store. And housing. Wow. For anybody thinking about buying a house, this has got to be a little bit scary because, well, opinions about buying a house today are about as bad as they've ever been. Now, why are opinions so bad about buying a house? Because, well, the narrative has said that. Every time you pick up a paper, there's another story about how expensive housing is. The intriguing thing is housing actually isn't that expensive right now. Oh, and it's definitely true that affordability is substantially worse than it was in 2019 or 2020. But that said, it's basically on par with where we were in 2005 and actually below where it was back in 1987. And by the way, in 2005 and in 1987, well, those were very healthy, active housing markets. So no, the housing market isn't all that, shall we say, out of whack the way you might think by looking at the news. That said, the real question is, why has the last decade been so affordable? And yeah, the answer is narratives, because the conversation about housing being so unaffordable was dominant back in 2017 and 2018, even though, again, back then we had record levels of affordability. Now, what happened, of course, all has to do with, again, the craziness of what happened over the pandemic. Look, the housing market was incredibly cold in 2019, mainly because everybody expected prices to fall and they were waiting for them to fall, which meant that nobody was buying homes, which meant that the market looked really cold, which convinced more people the prices were going to fall, which means they didn't buy a home. But that weird little vicious cycle got blown up roughly in the middle of 2020, when, of course, interest rates were low, there was piles of money out there, and people just got fed up with waiting. And as a result of that, they went out and they went really from 0 to 1,000 miles an hour when they realized that there was nothing to buy. And we went from nobody making a bid to 100 people bidding on every single house. The next thing you know, home prices jumped up at an incredible rate, and until, of course, the Fed stomped in the brake and interest rates went up at it after it. But with that said, while the increase in interest rates certainly slowed affordability, it didn't change the fact that the US economy has a massive shortage in housing. That's pretty much everywhere at this particular point in time. That's one of the reasons why the housing market continues to deliver new units, even in this quote unquote unaffordable market. Now, it isn't as easy as it used to be. And one of the problems that home builders have to do is they have to deliver product where people want it, which is different. Usually, home builders supply product through a process that we call filtering. Well, they typically build high-end, fancy new stuff because that's where the margins are fat. But that's okay, because when you build a new home, somebody leaves their existing home to move into the new home, and by leaving that existing home, well, somebody can move out of an apartment and move into that existing home. That is the filtering process. The real problem here, of course, is that that house in the middle is not selling. They have a 30-year fixed rate mortgage at probably 3%, and they have no interest in walking away from that property. So now builders have to deliver to where it's needed. And yeah, that can be a little bit complicated. That's why we have an odd surge in supply of units for sale, even though overall sales are still pretty good. But that's not the only issue. The price of building has gone up. So it isn't just that interest rates are up. The price of building has gone up 50% in the last decade. And the real issue here is that home builders need to learn how to supply smaller units. This is really the market needs to go. And that can be kind of tough, particularly with a lot of rules and regulations at the ground level. And now, of course, we have to worry about the insurance issues, particularly given, of course, the horrible fires here in Southern California. Now, insurance prices are going up by quite a bit. But again, let's keep in mind that the highest prices for insurance really still are in the Southeast, particularly Louisiana, Florida, and Texas. They're actually higher than, for the most part, here in California, unless you live in a fire zone, of course. But they are rising rapidly here because, of course, of the changes in risk. Now, insurance by itself is not a reason to be thinking that housing is going to going to collapse as a market. It's still shortage supply, even unaffordable. There's still simply more demand than there is supply, which keeps prices up. And even when it comes to insurance payments tend to be substantially less than, say, even your mortgage payments. So it's an issue, but not one that's going to upset the housing market. Yes, I would argue it's probably still a good time to buy a house, and I'll come back to that in just a few minutes. Now, the interesting part is when you think about insurance and when you think about the cost of owning, it's actually the issues are bigger in places like Texas and Florida. I already said their insurance problems are substantially worse, and they don't have a pool, they don't have a risk pool, a state-run risk pool, and they also don't have controls on property taxes the way California does. And as a result of that, the cost of owning is going up substantially in Texas and Florida, not so much here in California. And that is one of the reasons why those markets are seeing a little bit more liquidity, but it's not happy liquidity. It's unhappy liquidity where people are unable to carry the costs of their homes. That's not happening here in California right now. Now, will we get a little interest rate relief on that particular front? And I would tell you that the Federal Reserve has been remarkably resistant to, of course, um, acknowledging they caused inflation. But with that said, they did start to cut last year, as the case may be, and they backed off a little bit on quantitative easing. They didn't back off all the way on quantitative tightening, quantitative, but they did back off some on it. And the net result of that is, yes, the deposits started to grow again. That gave a little relief to the market. Interest rates in the low end came down a bit, not so much in the top end, again, because, of course, that quantitative tightening that's still going on. This seemed more about unwinding the yield curve than expanding the economy. Tomorrow's decision is going to be insanely interesting to see how they respond to all this volatility over the course of the last couple of months or so. Going to be very, very interesting. No prediction, no prediction. I have a sense they may back off in quantitative tightening just a little bit more, in which case they might cut the federal funds rate just a little bit, but they don't want to overdo it because keep something in mind. When it comes to conversations about what the Federal Reserve did, it isn't just inflation. They also set off yet again this asset bubble. Look, even with the little bit of a decline in the market we saw last week, the market valuation is still hovering perilously close to PE ratios that put it at the second highest ever, higher only below where it was in 1999 when it was wildly overvalued. And I like to point out to folks that if Bitcoin's a little expensive at $90,000 or $80,000, you could invest in Fartcoin, which, by the way, is not a sophomoric joke. There truly is a Fartcoin. It's, by the way, has a market capitalization of $300 million, and at 30 cents a share. Well, seems like a perfectly reasonable investment. And just to make my fears of bubbles get a little worse, well, it turns out that they're having record levels of asset-backed securitization going on. Although honestly, I'm looking across the economy and I can't figure out exactly what it is they're securitizing in this particular market. So yet again, I see lots of things here in our financial markets that don't make me look happy. And by the way, that brings me to what Warren Buffett famously said, be fearful when others are greedy. Now, that brings me last but not least to the federal deficit. You got to talk about the deficit, 6% of GDP at this particular point in time, driven by really a big increase in spending over the course of the last couple decades, not just the last couple of years, but the last couple decades. No, Doge can't fix it. Look, the vast majority of federal spending is completely dictated by law, by Congress. You'd have to change the law on Medicare, the law on Social Security. Obviously, people don't want to cut back at national defense right now. The interest payments you have to make, otherwise you blow up our global debt markets. When you think about this, they can't fix it this particular way. This is a smokescreen, as the case may be. But here's where I start to get really worried about stuff. Because look, if Americans aren't saving enough money to cover the federal deficit, well, then who is? Who's buying this debt? Who's saving on our behalf? And the answer is the rest of the world. And you can see this in the fact that our current account deficit is widening dramatically. It's getting close to 5% of GDP, not quite as bad as it was in 06, but getting there. And by the way, our net investment position, how much we own of the rest of the world compared to what they owe us, is the worst it's ever been. So we are a nation in the midst of a spending binge. We owe the rest of the world a record amount of money. You would think at this particular point in time, the rest of the world would be running away from us, but they're not. fact, they seem quite happy to invest in our economy. How do I know that? Well, take a look at the real value of the dollar. It's high. Now, what's this about? What's going on here? Well, there's a couple things. We have some uncertainty in the world, and when people are uncertain, they think the U.S. is the safe haven. We'll see if they're right. Um, the other part of it, of course, is that external investors are really intrigued in our markets, our stock market, our cryptocurrency market, even our real estate markets are some of the strongest in the world. And there is always this chase of returns, this chase of yields happening in global markets, even if those yields may not be quite the right thing. So you look at this and you realize this is the real problem. This is the real issue. Let me sum it up modestly different for you. This is a little complicated, but what this is the economy in the fourth quarter of the election year. And you can see what that president is bringing in. And when you look at Trump's economy that he brought in, it's the best economy of any incoming president, really since George Bush in 2000 and 2005. You have a 2.5 growth rate. You have a 4.1% unemployment rate. Yes, inflation's a little hotter, but interest rates haven't come up that much. Real incomes are up substantially. Household net worth is up great. What's amazing about this whole thing, and debt levels are down. What's amazing about this is only that consumer sentiment is so low. Well, that goes back to miserable. This economy looks great. We're delivering a record standard of living, but the only thing the political leaders hear is how terrible everybody's doing. Well, what a weird world that is. But here's the key. The reason we're doing so well is all the stuff at the bottom. The fact that the NASDAQ is insanely high. Our PE ratios are off the charts, higher than they've been in a while. Our deficit, again, outside of Q4, which had very specific reasons for it, an enormous deficit. Federal debt is a percent of GDP. Current account, I already talked about net investment, and that strong dollar. We're a nation in the midst of a spending binge. When the rest of the world realizes the risk is here, well, the dollar starts to fall, the cost of imported goods goes up, and we have a big shock to interest rates yet again. The question is right now, interest rates, they seem to be steady. But from my perspective, at some point out there, there's going to be another big increase. And yeah, that's the thing that could really hit American households. How far would this go? Again, you've seen all of it, right? We have all these things going on, sentiments falling, even to the point where Lutnick says that Trump's policies are maybe worth it. So maybe we're just going to charge right ahead. You know, he might be right. Let me throw something out at you. We know the economy is growing in a way that's not sustainable. Would it be better for us to stop it now, have a rough year and a half, and then get going with a clean slate? Or would it be better to let it pan out 3 or 4 more years and get it worse? And then when the recession hits, it's that much uglier. I don't have an answer for you. What I do know is the people in DC aren't discussing that particular question. Their narrative is something completely different, and therein lies the biggest danger of all. Look, we're not out of the woods because we are never in the woods, and the economy is going to continue to expand. There's just no doubt about it because of the momentum, because of the strength of American household finances. But those finances are based on deficits and fraud of the asset markets. Those are unsustainable. When they break, the economy breaks with it. I don't know when that happens, but keep an eye on the dollar. That's going to be the most important indicator. As for consumer credit, look, if you said to me today, should I be buying a car? I'd probably do it really quick because you have no idea what's going to happen if trade wars really do kick off. What about a house? Same sort of conversation. Rates could be going up again. But with all that said, go back to the lesson of those credit card increases in delinquencies. And remember, these are people who got ahead of themselves, who thought the good times were always going to be there, and were just paying attention to the idea that whatever growth was last year is going to be again next year, and it's okay to borrow against that. Well, whatever you do, if you want to buy that car, you want to buy that house, go out and do it, but don't get out over your skis. Don't buy the fancy car if you can get a cheaper one. Don't buy the 5-bedroom house if you can fit into a 3-bedroom house. These don't need to be your dream homes and housing. Those things fade off quick. Go out, take advantage of the rates while they're here, but don't think that this economy is going to continue to smoothly expand. There's going to be a pothole out there, And when that happens, you don't want to be over leveraged. So make the right decisions, be cautious, and remember, ultimately, the real issue is, of course, narratives. The fact that our narratives are running amok and it's bringing policy along with it. And it's weird because shouldn't we be the smartest people ever? Welcome to the information age. Well, a wonderful study that came out a few years ago, The Future of Truth and Instant Information, said something really profound, that new information platforms feed the ancient instinct people have to find information that syncs with their perspective. The information environment will not improve. The problem is human nature. And I'm going to go to the next step on that, because what's really driving this is type 1 thinking. Look, when your type 2 brain goes to the internet, it's looking for an answer. When your type 1 brain goes to the internet, it's looking for confirmation. So unfortunately, because too much of our letting our type 1 thinking drive the show, well, it's not the information age, it's the age of confirmation bias. Ultimately, to fix the problems in our world today, we have to start with us. By us being a little bit more humble that maybe how we see the world isn't exactly right, well, that's how we all get the economy back to something resembling, well, a world where narratives and reality line up a little bit better. So with that, thank you very much. Roger, come back to me. There you are. Great. I'm going to leave the QR code up just for a couple seconds, then we'll get to the last line. But hopefully, I got some good questions. What do you got over there?
Got a number of questions,
Good.
and we're kind of watching time, but let's see if we can get outstanding presentation, Chris.
Thank
Love,
you.
love that you touched on a lot. I know we covered a lot, so it was really outstanding. Let me go through. We have a number of questions. In fact, one of the things that it's on another slide, but one of the questions was someone had joined late and they asked a question, would they be able to see the information? So in case you missed Chris' earlier point, you can get a slide deck by using the QR code. We also are recording this presentation and we'll make that available sometime, not usually it's not too long after these sessions. So if you missed the first part or just want to go back and
Okay.
here, kind of go back to a certain section, you'll be able to do that shortly after. So I'll at least try to touch upon, we have a number of questions. I don't think we have time to get to all the ones specifically, but let me
Sure.
see if I can maybe get to some of the themes of them. So, and I think some of them I'm looking, because I think they were asked during your presentation. So some I know were already answered. So let me go back a little bit. So I think you really answered the issue about, the impact of Dodge versus, the other, more major programs. I think that one you covered. Talked about, so the debt is a concern. You talked about that. Here's one, and I know partly I'm going to pause on this one because I know you know the Bay Area quite well, Chris.
Yeah.
Someone was mentioning the housing section of the presentation doesn't seem as relevant to the Bay Area because of high cost areas like the peninsula. Many homeowners have either no mortgage or are locked into sub 4%, which
Well, that's just it.
restricts
Yeah.
supply
Yeah.
despite weak demand due to affordability challenges. So I picked on that one in part because I know you have quite a bit of insight in this area.
Well, I mean, look, the Bay Area is front and center, the poster child of housing shortages. Um, they haven't built enough for a long time. And it's so interesting because I was just up there. I gave a talk in Contra Costa not too long ago, and Contra Costa has actually seen some positive job growth after years of almost no job growth. And the reason for positive job growth in Contra Costa is the fact that tech briefly swooned. I mean, everybody's worried about the slowdown of tech in the Bay Area, but you have to understand how distortionary tech is to the Bay Area because they won't build enough housing. It grows, it absorbs every bit of housing in sight, and other sectors of the economy get pushed out completely. So tech may be thriving, but other sectors suffer, and that's really bad for the Bay Area. The best way for the Bay Area to get over this problem, by the way, we have a term for this called Dutch disease, is obviously to build enough housing to allow the economy outside of tech to expand. And when I told the folks in Contra Costa is, be glad you get a low job growth right now because as soon as tech does bounce back, watch out. That housing is going to go. Housing supply is going to just any little bit of housing supply is going to disappear very quickly yet again. So building housing critically important to the Bay Area, but yet again they seem to be way too worried about what I would call the short run issues. That is to say that slow that cyclical decline in tech jobs as opposed to the long run problem with the fact that their labor force has contracted pretty sharply over the course of the last 5 years.
Great insight. I know you talked some about labor force or labor supply issues, and someone asked, do you think artificial intelligence will be able to fill in the shortage? It makes me think of like some of the, I don't know that you had
Yeah,
a chart on it this time on
yeah,
productivity charts and things like
yeah.
that, but will AI be able to materially kind of fill in the gap we have on
Yeah.
labor supply?
Somewhat places, yeah. Look, you got to AI is not intelligent, okay? It's one of the things we have to keep in mind. It doesn't have the kind of creative spark human beings do. They haven't built systems that work like us yet. I mean, who knows, right? With that said, it's very good at some very complicated tasks. For example, it's very good at searching mounds of textual information as opposed to numeric information. That's a big shift, which will make the internet hopefully more usable. It'll also make it easier for you to go out and find out reasons why the earth is truly flat. Again, be careful how you use it. That said, the real gains from AI, I think, are going to be in these small corners of the world. It's going to make medicine, should make medicine much better. AI is clearly perfect for diagnosis, can make healthcare much more efficient in terms of what it does, and that can help everybody. I think it's also going to be good in some complicated manufacturing tasks. There's still a lot of places where you got to use people just because the machines can't do it, whether it's fine welding or picking strawberries. Well, here yet again, you might see some gains from AI helping that. It should make legal costs go down, and that everybody should be able to applaud that, right? Because again, you can go through piles of information. So I think there are places where we'll see productivity gains as long as we don't stand in the way, but it's not going to replace the nuts and bolts in your life. And I'm sorry, Gen Z, I'm going to tell you right now, the AI girlfriend, it's not going to last, Chief. It's just not going to last. You might want to let her down now. Go find a real one. So,
Very good. And Chris, somewhere earlier when I was scanning, I think I saw a question about, I think related to AI, and I'll just call it, application of the credit union. It reminds me of some of your comments. What we see, and certainly it's another technological capability we certainly want to learn more about, take advantage where it helps us provide even better member experiences, more effectiveness, more efficiency. In many regards, we think it's going to help our great talented team members to help members even more quickly and maybe even more comprehensively because they're able to get the information at their fingertips. So there are certainly some self-service applications we think, but we're certainly still learning more. But it's more around, what can it help us do that we can do more for the member quicker, better, make doing business with the credit union even easier. So some of your comments globally reminded me of that
absolutely.
earlier question.
Yeah, it leverages labor. It doesn't replace
Yes.
labor. And that's always what you need to keep in mind with these kind of advancements.
Someone else asked about just, again, looking for themes here about kind of the impact of the federal layoffs that we hear about. And by the way, I know I've read some. In fact, I think I even caught something in the Alaska Daily News, but it wasn't just there. We hear about the federal, layoff federal employees. Doesn't mean it's just in DC. And I think the theme of the question is just trying to understand, do you think going to have a material impact on economic trends?
Now, I mean, a couple reasons here. I mean, yes, I understand. It's so easy when if you look at where the bulk of news pays attention, right? Where the news systems are focused, they're focused on the most titillating story, not the most important one, right? And there's nothing. I mean, wow, this whole thing with Doge and Elon Musk, it's super titillating. Both sides, right? One side loves it, the other side, the one side loves to love it, the other side loves to hate it, if you will, right? That's where we are right now. But that being said, federal employment is 2% of the U.S. economy. The vast majority of people are not going to be let go of, and even some of the people who are let go are getting hired back. So the actual disruption to our labor systems is probably not going to be that large. And look, I also ultimately the making federal employees the center of this, I think, is a mistake. because it makes it look like the real problems in DC are driven by the bureaucracy when these are just people out there doing their jobs. Now, I get sometimes they're not doing it quite as hard as maybe we like them to, and Lord knows there's never been a very efficient government bureaucracy in the history of mankind. By the way, most private sector bureaucracies aren't terribly efficient either. News to people. That's the nature of the beast. With that said, you make do. Don't pretend there's some magic bullet out there. All that being said, again, the problems with our federal government is not that. It's Medicare, it's Social Security, it's the interest payments. These are the big ticket items. It's defense spending. These are big ticket items. And as a nation, we have to acknowledge something, which is if we want them, you got to pay for them. And if you don't want to pay for them, then you have to shrink them. At some point in time, we have to get to the basic realization that we can't have our cake and eat it too. And man, I got to tell you, that is a lousy platform to run on if you're ever going to want to be president. But tragically, that's exactly the one this nation needs to hear.
Thank you, Chris. So a few, I'd say, sprinkling of this topic and a few questions. And I'm watching time, so I'm just going to maybe do a couple more. I think the gist of it was, are demographic shifts really a driver of so many of the trends that you covered, or not so much?
Well, it depends on what kind you're talking about, right? The long run trends are 100% demographic, right? The capacity for our economy to grow is a function of how many people live in our economy. It's not complicated. It's as simple as that. Um, that said, um, look, if we don't want the country to grow, maybe people want the country to be exactly like it is now. They don't want outsiders coming here. Look, we live in a thing called a democracy. And if the majority of people don't want people to move here, well, okay, it's a democracy. You get to make that call. That's what it's about. That's the idea of majority rule. The problem here is when people don't want to let immigrants in, but they still think the economy should grow faster. And they still can't figure out why we're having trouble paying for our Medicare and Social Security. This is that conflict, this cognitive dissonance that we all need to figure out how to work out of our systems. I'm not even sure I answered your question.
Well, I think you got to the
Yeah,
main issues. I mean,
yeah,
and some of it you spoke of, even in terms of birth rates and other issues. So I hope I didn't, I was trying to paraphrase, but I know there's a couple of
yeah,
comments. Let me read one. I think it's really well stated, and we'll probably have to wrap up since we were planning this only be an hour, and
yeah.
we're a bit over that. But I want to get maybe one more in.
Sure.
And it relates to your optimism about, kind of the recession, how the economy's going. I think you said you don't expect a recession in the next 12 months.
No, yeah.
It's while your optimism for GDP growth and low recession odds look solid, but issues like wine industry crisis, auto sales decline, flat retail wage growth signals risks. With recent political volatility and policy shifts under the new administration, what's the biggest long-term threat to your expansion to continue outlook? And maybe there's a couple here. I'll read it and then you can just answer what you can in the brief time we have. How are you modeling potential downturn from policy turbulence or external imbalances, and what safeguards might you be even overlooking potentially?
Okay. No, great questions and big ones, and yeah, good place to end up. So to be clear, yes, the economy has a lot of momentum. It will continue to carry us forward. Um, but that's not the problem. The problem is, again, the momentum we have is based on these lousy foundations, asset bubbles and federal deficits that are not sustainable. So even if I'm optimistic about the economy growing in the short run, at some point out there, there's a problem. And the problem could be in 2 years, it could be in 4 years, it could be in 6 years. There's a lot of ground, there's a lot of narratives between us and when this thing actually snaps. And yeah, it could happen more rapidly. One of the things I was trying to get across is the fact that if Trump keeps shaking it up, yeah, maybe it will freak out the markets. Maybe it will freak out foreign investors. Lo and behold, everything I was worried about, a declining dollar, increase in interest rates happens now, and we could be in a recession by beginning of next year. With that said, the quicker this recession occurs, the milder it's going to be, right? It's the longer we go on without acknowledging these issues, the harder the reset's going to be when we inevitably get to that point in the time. That is the trade-off we all have to be thinking about. And that brings me to the real question, because the real issue here is, why can't we turn around and confront these imbalances? And the answer is because the back and forth between our political leaders and our population is completely off base. The left and the right both agree that the world is terrible and it's the other guy's fault. And the Democrats and the Republicans are being forced to offer a higher quality of life to a bunch of people who already have the highest quality of life possible, probably higher than it should be, given the fact that we're in the midst of this consumption binge. This is the disconnect. The fact that we don't have the context to appreciate just how good we have it. This is the problem. And that's a function of us. Now, this is not new. This is the human condition. This is who we are. And in the past, this has ended ugly. And by the way, a great point in the past where you saw how ugly this was the Great Recession, because this was a very similar run-up in terms of the excess consumption. And look how badly that damaged the economy. I'm not saying we're going to get there again. But what I am saying is we all need to have a little sitting down, a little conversation with Dad about balancing the checkbook and having a little appreciation for how good we have it, as opposed to constantly whining about what we don't have.
Sounds like maybe we're doing a lot of systems one thinking these days.
We are.
Given what you said earlier, yeah.
And I think that's the internet in a nutshell, right? I mean, the internet's just out there kicking you in your moral nose every time you're not looking. So
yeah. Well, great insights, Chris. Thank you so much. Hey, while I'm maybe doing some closing comments, can you go back to the QR code slide?
Sure.
I saw a request for that, just to leave that up a little bit longer. There you go. Hopefully that helps those, so you can get the slides. Again, we're going to have a recording, but just great insights. You know, you talk to enough economists, you're going to get a lot of different opinions. I'm so glad that, you know, I very much respect Chris's opinions, and just the way he forms them based on the data and facts and trends. And Chris, just outstanding presentation. Thank you so much for being with us. To our members, thank you for your business. Thank you for joining us. We hope this was of value, at least food for thought. You know, certainly everyone can have their own opinion, but I think this hopefully provided you some good information for which you could make decisions in your own life. And we hope it was valuable and worth your time. Again, we thank Chris from Beacon Economics for being with us again. And we're going to have this recording up on, I think it's Facebook and YouTube shortly. So look for that if you'd like to check that out again, or go back to a particular section. So we're just, again, here to provide you information that we hope is valuable. And Dr. Thornberg, Chris, thank you so much for being with us tonight. Thank you, everyone, for joining us.
Roger. Appreciate it.
All right. Have a good evening. Bye-bye.